Russia's Ukraine invasion could profoundly change global economics as we know it. Skyrocketing gas prices and rapidly shifting trade decisions suggest events of the past few weeks will be felt across the globe for years. Russia's invasion of Ukraine and the financial hitback imposed on Moscow in response are signs that global economics as we know it are about to change drastically. Fallout from the fighting in Ukraine will take a meaningful bite out of the global economic recovery this year, following 2 years of the COVID pandemic, with the greatest impact in Europe. A spike in oil prices to more than $110 per barrel and renewed supply chain disruptions, including a new round of problems for the auto industry, also are likely to aggravate U.S. inflation, already at a 40-year high. But the war's long-term consequences could be even more overwhelming. Even before Russian President Vladimir Putin sent tanks and missiles hurling toward Ukraine, years of deteriorating U.S.-China relations and failed global trade talks had stalled the tighter integration of finance and trade flows that had been anticipated during globalization's heyday. What comes next is unlikely to mirror the Cold War's distinct blocks. Even as the global economic order fractures, no rival ideologies compete for supremacy, and China's harsh authoritarian turn under President Xi Jinping coexists with the extensive commercial ties to the United States, Europe, and Japan. But governments, corporations, and investors all are adjusting to a new reality. Like it or not, one era is ending and another is beginning before our eyes. The new era is a less complete form of globalization than we had ambitions for in the immediate post-Cold War era. We have to think differently about what we mean by the global trading system. There are certain requirements that, if you don't meet them, you're not part of it. You may not be able to place yourself in the popular club. With the United States, Europe, Canada, Britain, and Japan uniting to punish Russia with unprecedented financial sanctions, the war has triggered a major geopolitical realignment very similar to the aftershocks from the 9/11 terrorist attacks. Virtually overnight, most major Russian banks were blocked from moving money across borders. Moscow's stock market has been closed like never before. Russian customers are cut off from much of the world's most advanced technologies. Russia's isolation deepened as the country's communications regulator blocked access to Facebook, one of the few sources of information that the government already did not control, saying it had discriminated against Russian media. In Washington, top Democrats and Republicans forced the Biden administration into not only sanctioning Russian energy, but also cutting off financial ties to the country altogether, a move that will intensify Moscow's financial plight if European nations completely follow suit. Meanwhile, the International Monetary Fund is warning that the war and rapidly accumulating sanctions on Russia would have a severe impact on the global economy. Russia's financial exile caps more than a decade of erosion in globalization, beginning with the 2008 financial crisis and continuing through the rise of China's Xi in 2012, the U.S.-China trade war that began in 2018, and diplomats' repeated failures to agree on trade liberalization. The coronavirus pandemic, which highlighted the risk of ocean-spanning supply lines and restricted international travel, further thinned cross-border links. Together, Russia and Ukraine account for 3% of global output, according to J.P. Morgan Chase. Putin's brutal invasion of his neighbor, however, will have broad economic repercussions. Considering Putin's human rights violations, there is a real chance that China will be shut out of the global economy for a long time. This would remove a big chunk of the global economy and going back to the situation we had in the Cold War when the Soviet bloc was pretty much closed off. But that doesn't mean the rest of the world can't be tightly integrated in terms of trade and finance. Expectations for an enduring era of peace and prosperity were high in the early 1990s. After the Soviet Union ceased to exist in December 1991, Russia launched a helter-skelter series of economic reforms, including establishing the country's first stock market and welcomed foreign investors. China, meanwhile, was also moving along a market-oriented path that relied upon access to foreign technology, capital, and executives. From the outset, many U.S. officials saw a link between political and economic freedom. By the year 2000, when Congress was debating China's entry into the World Trade Organization, U.S. President Bill Clinton saw trade ties heralding very profound change, including in the country's political system. By joining the WTO, China is not simply agreeing to import more of our products, it is agreeing to import one of democracy's most cherished values, economic freedom, Clinton said at the time. The more China liberalizes its economy, the more fully it will liberate the potential of its people, their initiative, their imagination, their remarkable spirit of enterprise. And when individuals have the power, not just to dream, but to realize their dreams, they will demand a greater say. Hopes for a steady forward march of free markets and free people have proved unrealistic. Globally, democracy is down, poverty is up. The number of countries considered not free by the nonprofit Freedom House and those with annual average economic growth of less than 3% have risen in tandem. Even before the pandemic drove the developing world into deeper poverty, about 70% of the world's countries were experiencing subpar growth, roughly 3 times the figure in 2008, according to the World Bank. Non-democratic rule similarly spread across much of the globe. In 2020, for the first time in more than 2 decades, global poverty increased, according to World Bank data. Russia's recession will intensify that trend, including in the Central Asian republics that once were part of the Soviet Union. Remittance from migrant workers from Central Asia who work in Russia make about 30% of the economy in both the Kyrgyz Republic and Tajikistan, and are almost certain to plummet as Russia plunges into a deep recession and the ruble sinks. World trade volumes would be nearly twice as high if they had continued on their 2000-2008 path, according to data from CPB Netherlands Bureau for Economic Policy Analysis, an independent research institute. Likewise, major cross-border financial flows have virtually stagnated even as the global economy grew about 30% larger since 2008. Top banks have $31.1 trillion in foreign exposure today, little more than the $30.4 trillion in early 2008, according to data from the Bank for International Settlements in Basel, Switzerland. Financial markets that once rose and fell in near lockstep are increasingly going their own way, according to MSCI research. A decade ago, markets in different regions moved together about 80% of the time. Today, the correlation is a bit more than 50%, reflecting less of a globalized economy. It's not that globalization is over, but it will be different. This can be seen as the door closing on a chapter that never had a strong intellectual basis. It won't be the same. What we're going to see is a process of delinking and disengagement. But it's going to be slow, particularly in the case of China. Indeed, the United States since 2018 has been limiting the flow of high-tech goods to China and raising tariffs on Chinese imports. Chinese authorities, watching the United States and its allies deliberately shove Russia into a deep recession, are expected to intensify their efforts to become more self-sufficient in the production of goods such as semiconductors. The United States, too, is moving in that direction with Biden's Made in America initiative designed to spur domestic manufacturing. China's economy, however, is 10 times the size of Russia's and is far more intertwined with the outside world, making it unlikely that Beijing or its trading partners would seek a complete divorce. The war's immediate impact on the U.S. recovery is likely to be limited. Total U.S. two-way trade with Russia and Ukraine last year amounted to $40 billion, and Wall Street banks have less than $15 billion at stake in loans to Russian borrowers. But there will be collateral damage from the sweeping U.S. and allied sanctions that have slashed most of Russia's links to global trade and finance. Gas prices in the United States may soon smash $5 a gallon. Russia also is a major producer of other commodities, including wheat and industrial metals. The price of palladium, which is used to make catalytic converters, is up more than 60% this year for automobiles. Renewed supply chain disruptions also will put upward pressure on inflation. Both Federal Express and United Parcel Service have halted shipments to and from Russia. Maersk, the giant ocean cargo carrier, stopped accepting new bookings this week for Russia-bound goods, causing cargo to begin piling up at terminals across Europe. Cargo is getting delayed and already congested transshipment hubs are getting more pressured. This is a global impact and not only limited to trade with Russia. We will have to change our view and mentality of global economics altogether.